there are 4 more Federal Reserve Open Market Committee meetings, or FOMC meetings, left before the November presidential elections. The next meeting is on June 20th. The markets want to know if Ben Bernanke will announce more QE, stimulus, or whatever new name the Federal Reserve decides to name the next round of stimulus at June's FOMC meeting. The market also is already speculating on what the Fed will do with the money. Will they purchase U.S. Treasury debt and monetize more debt, or will they purchase more toxic assets from government agency or bank balance sheets? Hedge funds are already positioning themselves and speculating with big bets on where the next stimulus will be directed towards. The major questions everyone wants to know is how much longer can Helicopter Ben wait until the next round of stimulus? Will the markets accommodate the Bernanke and not crash, or will the markets have a violent 15% or larger correction prior to the November elections? Or will the markets not crash and merely stay in a trading range so the next round of stimulus can be held off as long as possible? In a perfect world for central bankers, Ben Bernanke and the others at the Federal Reserve would prefer to wait until after the presidential elections in November before they inject more stimulus into capitals markets. But I doubt the markets are going to accommodate their wishes as things appear to be worsening globally. European banks have not been properly recapitalized compared to what American banks were after 2008, and many European banks will need far more than the €100 billion bailout that was just promised to Spanish banks over the weekend to temporarily stem the tide. We are in a situation where the law of diminishing returns is already attacking Ben Bernanke and other central banking solutions from their Keynesian playbook, like a drug addict taking more hits of drugs and larger doses and then receiving and dealing with less of a high. China's M2 money supply has also been declining rather rapidly as China intentionally slows down their economy. This was intentionally done to try and prevent a hard landing and to cool off near hyperinflation in food prices last year after QE2 was announced, as food price inflation was over 20% in China for much of 2011, prior to the Chinese central planners trying to intentionally slow down their economy to reduce inflation, inflationary expectations, and therefore velocity of money in their banking system, as Chinese citizens rushed to take out their paper money and buy food, physical bullion, and other purchases fearing worsening inflation. The problem is that Chinese banks and municipalities are still sitting on bad loans and investments, and these loan losses and malinvestments will need to be covered by China's trade surplus in the form of a bailout sometime soon. Also, one of China's largest trading partners, Europe, is looking like it will be importing much less in terms of goods from China, plus potentially adding on tariffs on Chinese goods in the near future, as European industry, not counting Germany, looks to rebuild its manufacturing base. It is looking like China's central planners will decide they need to do some kind of stimulus for their own economy to start transitioning to more of a balanced economy soon, as well as to help cover bad loans given out by their banks and municipalities, and to potentially paper over any of the malinvestment bubbles in housing China has to attempt to manufacture a soft landing instead of a hard landing. Professor Michael Pettis, who teaches out of China, wrote a great article about this a few months ago, and I encourage GoldSeek radio listeners to check it out when they have time. The bottom line is that China is not going to be able to rely on the US and EU nearly as much now to help to continue to fuel their export growth, so expect China sometime in the next 6 months to start redeploying their substantial trade surplus or foreign exchange reserves into transitioning their own economy. This brings us back to the Fed. If China or Japan devalue and do more stimulus or QE of their own, Ben Bernanke will be forced to retaliate against them in this current currency war and continue all paper fiat currencies race to debase. A weaker euro, especially if Greece does exit and then attempts to hyperinflate their debt away, will also strengthen the argument for Ben Bernanke to do another stimulus sooner than later. Greece leaving the euro would be good long term for the strength of the euro, but it might cause massive short-term weakness as bond vigilantes and short sellers start to attack other PIGS countries' sovereign debt and attack the American and European banks holding the largest derivative exposure to Greece. Why else has Ben delayed the next stimulus? Well, immediately after QE2 was announced, commodity prices took off. This worried the Fed as inflationary expectations and velocity of money increased rapidly, and higher food and energy prices acted as an additional tax on consumers in the U.S. and slowed down any signs of a recovery. When food and energy and other commodity prices increase rapidly, consumers cannot spend nearly as much of their paychecks on consumer discretionary items, as they are forced to spend more of their paychecks on food, energy, and other consumer staples just to survive. Businesses also have higher input costs due to inflation and are much less likely to risk expanding and growing their businesses, so any potential hiring of new employees to help with the business growing would be delayed or canceled. After QE2 expired, the market and many commentators incorrectly assumed the Fed would immediately do another round of QE right afterward. But the Fed delayed this because they're worried about the increases in commodity prices, and the Fed was worried about accelerating inflationary expectations and velocity of money that would come from doing QEs immediately, one after another, with no break or cooling off period in between. In the year or so since QE2 has expired, commodity prices have corrected sharply. Oil is currently at around a 7-month low. This is another strong argument for why the Fed now has a lot more leeway to do another round of stimulus sooner rather than later. For GoldSeek listeners who are contrarian investors, traders, or speculators, I am of the idea that it is a very smart idea to be starting or adding to positions in physical bullion, gold stocks, silver stocks, and oil stocks at these levels. A great contrarian in the markets avoids doing what the herd is doing and does the exact opposite in fact. I am putting my money where my mouth is and adding to positions in top gold and silver producers, as well as adding new positions in oil producers. I have made my biggest percentage gains in stocks over my investing career when I bought positions when others were too afraid to buy. Producers in gold, silver, and oil have underperformed their underlying commodity by more than 2 standard deviations since 2011. A great contrarian is greedy when others are fearful, and fearful when others are greedy, and is buying when there is blood or massive losses in the streets, even if that blood is their own. This requires a lot of discipline, courage, and conviction, but contrarians who are taking advantage of the bargains in gold, silver, and oil should be rewarded handsomely in less than 18 months in my opinion. We are literally back to 2008 sentiment levels concerning the gold and silver production companies, and the underlying businesses of these companies are much more profitable with better profit margins, yet the market is pricing in gold and silver to not even stay at these post-correction consolidation levels. Hopefully, listeners can see the point I am making now about how irrational the markets are acting right now. The markets are in total fear and panic mode in the commodity sector in terms of valuations, and have completely forgotten about greed. Soon, sentiment could shift, and when sentiment shifts back towards greed or risk on, valuations could spike rapidly as we revert back to the mean and producers stop underperforming the underlying commodity by so much. Although stock prices have gotten clobbered, the underlying businesses of the gold and silver production companies have never been more profitable. In conclusion, I expect China, Europe, and possibly Japan to devalue first in this next round of currency wars before Ben Bernanke retaliates next with another round of stimulus. Having hedges in your portfolio, like some cash, bullion, or puts to your resource stock long positions is probably still a good idea in case the Fed is able to delay its next stimulus for another few months, but the resource stocks definitely appear to be very close to bottoming, as much of the selling pressure and basically all of the leveraged hot momentum trend traders have left the sector. For those of you listeners looking for additional education and research into the oil market and some good investing ideas, as well as a complete analysis of the oil market through my Austrian school lens, we suggest listeners should visit the website of the new oil report, the Petro Profit Report, that Wall Street for Main Street has just put on sale. This is why I've not done any new commentaries recently in the last month for GoldSeek Radio, as my team over at Wall Street for Main Street and I have been very busy working on this report. We literally spent more than 2 months doing additional extensive research into the oil market on top of our already extensive previous knowledge we have accumulated the last few years to analyze and understand this market through our Austrian school free market lens. The Petro Profit Report presents a lot of value for the price and offers insights into the oil market along with 17 stock picks found nowhere else online in this 45-page report. Please visit the Petro Profit Report website at http:// www.petroprofitreport.com, or the Wall Street for Main Street website at http://www.wallstformainst.com for more information on our report, or to learn more about my company and to find our own unique content.